Welcome to today's deep dive. Let's just start with a reality that might sound a little bit counterintuitive right now.
Right.
Because in 2026, the global weather is quietly doing way more damage to your portfolio than like anything happening over on Wall Street.
Yeah, absolutely.
You already feel it when you swipe your card at the grocery checkout or when you're standing at the gas pump just watching the numbers spin completely out of control.
That's painful.
It really is. So today is May 22, 2026, and we are going to look at the invisible architecture behind those exact price spikes.
Because it really is a profound shift in the whole macroeconomic environment.
Yeah.
We aren't in that era anymore where central bank interest rates are the only thing driving the markets.
Right, the easy money era.
Exactly. We are dealing with physical reality now, like literal supply chains, physical shipping lanes, and actual harvest yields.
Which brings us to the core of what we're looking at today. We've got this highly detailed research report on the table from David Mezicek.
He's a junior quant analyst over at Quantpedia.
Right, and his paper is titled Commodity Portfolio Strategy for a Potential 2026 Inflationary and Supply Shock Regime. And I'll be honest, my initial thought when reading quantitative research is that it's going to be, just a ton of dry math.
Oh, it usually is.
Yeah, but looking through this one, it honestly reads a bit more like a survival manual for the current economy.
Well, what's really fascinating here is how the report just completely refuses to view inflation as this vague monetary phenomenon.
Right.
It actually isolates two massive tangible forces that are currently dictating commodity prices. So first, you have the geopolitical instability in the Middle East.
Which is just this constant slow burn crisis.
Exactly. And it occasionally flashes into these severe escalations. And when shipping lanes, like in the Red Sea or the Strait of Hormuz, are threatened, the global energy transit network simply chokes.
It just bottlenecks. And oil prices react instantly to that because, modern economies literally cannot function without it.
They cannot. But then you have this second force, which feels entirely disconnected from human conflict.
Yeah.
And that's the El Nino climate cycle.
Oh, man. Yeah. Mother Nature basically running her own supply shock.
That's exactly what it is.
Yeah.
The El Nino cycle fundamentally rewires global weather. So when the surface waters of the eastern Pacific warm up, it shifts the entire atmospheric jet stream.
Which messes up everything.
It really does.
Yeah.
From an agricultural standpoint, that means areas that rely on, consistent seasonal rains suddenly face these crippling droughts.
Right.
While dry regions just get flooded. It ruins planting seasons and destroys harvest yields all over the globe.
So we've got human conflict squeezing the global energy supply and a massive weather cycle squeezing the food supply.
Yes.
Naturally, there is a lot of money to be made if you, position yourself correctly in commodities right now.
If you know what you're doing.
Right. But these markets are famously ruthless. Okay, let's unpack this. It feels kind of impossible to systemize chaos.
It does.
Like, how do you take advantage of this? You can't just put a hurricane or a geopolitical conflict into a spreadsheet and expect like a perfect forecast.
Well, no, you certainly can't predict the actual catalyst.
Mm-hmm.
But you can build a mathematical framework around how prices behave after the catalyst occurs.
Oh, okay.
And that is exactly what the Quantpedia paper achieves. But to figure out the best approach, the researcher first had to establish a baseline.
A starting point.
Right. You have to understand how a normal, everyday investor might try to play this market just to prove why that standard approach ultimately fails.
So the baseline they set up is this very straightforward equal weight basket of 10 commodity ETFs. Let me just translate that for a second for anyone listening.
Good idea.
An ETF, an exchange-traded fund, is basically just a financial basket you can buy right through your normal brokerage account.
Yeah, very accessible.
Yeah, so instead of owning shares of, say, a tech company, that ticker symbol tracks the physical price of a resource. And the report uses an even 10% allocation across 10 of these.
Which gives the portfolio a very broad, very diversified foundation.
Right, so you've got Canadian for sugar exposure, GLD for gold, USO for United States oil.
The big ones.
Yeah, and then they round it out with copper, corn, palladium, platinum, silver, soybeans, and wheat. So you are basically covering all your bases.
Agriculture, precious metals, industrial metals, energy, it's all there.
Right, and if a financial advisor pitches this to you, it sounds incredibly safe, like, oh, just buy a little bit of everything and hold on.
It's the classic advice.
It is. And looking at the baseline data here in the report, a passive investor would be absolutely thrilled. It captured a year-to-date return of 33.1%.
I mean, a 33% gain in a single year is a phenomenal return for literally any asset class.
It was massive.
It is. However, the data reveals a catastrophic vulnerability in this passive approach. The historical maximum drawdown for this exact equal-weighted basket is negative 27.0%.
Wow. Okay, let's really think about what a negative 27% drawdown means in the real world for you listening.
It's brutal.
It's completely brutal. You build this portfolio, you check your brokerage app, and you see you're up 33%. You feel like an absolute genius.
Of course.
But then the market turns. You log back in a few months later, and more than a quarter of your total wealth has simply evaporated. It's like riding a roller coaster without a seatbelt.
That's a great way to put it.
Like, sure, the view from the top is great, but that sudden plunge is going to make anyone sick. If the baseline is this bumpy, why are we even starting here? Why does a diversified basket of commodities crash so violently?
Well, it's because commodities are uniquely cyclical in a way that regular stocks or bonds are just not.
Okay.
They are hypersensitive to macro-driven demand shocks. So if global manufacturing slows down even slightly, the demand for industrial metals like copper plummets overnight.
Because nobody's building anything.
Exactly. Or if South America suddenly reports an unexpectedly massive soybean harvest, the global price of soybeans craters.
Because the market is suddenly flooded with excess supply.
Precisely. Which means buying and holding commodities forever is a trap. You ride the massive inflationary waves up, but you get utterly crushed by the inevitable supply corrections on the way down.
Okay, so if passively holding everything guarantees a 27% loss eventually, the logical next step is to figure out how to actively dump the losers before they drag us down, right?
Yes. And that brings us to the first active strategy tested in the research, which is cross-sectional momentum management.
Okay, cross-sectional momentum sounds like something straight out of a physics textbook.
It does sound a bit academic.
Yeah, but I'm guessing this is essentially a survivor strategy. Like, instead of holding all 10 ETFs blindly, we rank them against each other and only put our money into the ones that are already winning.
That is the core premise, yeah. You rank the 10 assets based on their historical performance, and you only allocate capital to the strongest trends.
Makes sense.
But the most critical variable here is the lookback parameter. Basically, how far back in time are you looking to determine who the actual winner is? And the research concludes that a 12-month look-back period provides the most stable foundation.
Yeah, I would assume looking at just the last week or even a month would be way too noisy. Like, social media rumors or a single delayed cargo ship could spike the price of oil for just a few days.
Which is precisely the issue with short-term metrics. Commodity supercycles are driven by deeply entrenched structural imbalances.
Yeah.
A 12-month look back captures that actual physical reality.
Okay.
Because think about it, if a major copper mine in Chile halts operations, you cannot just spin up a new mine next week.
Right, it takes years of permitting and heavy engineering to fix that.
Exactly. Or if a drought wipes out the U.S. corn crop, you have to wait an entire year for the next planting season to replenish the supply.
You literally can't rush nature.
You really can't. So the 12-month window perfectly filters out the daily noise and identifies these massive, slow-moving realities.
Okay, so we take our 10 assets, look back 12 months, and just buy the absolute best one, the top one strategy.
Yeah.
And when the researchers ran that data, the annualized return jumped to 17.53%, which completely blows past this standard benchmark. But here's where it gets really interesting, because while a nearly 18% return sounds like we just unlocked a cheat code for the market, I'm looking at the risk metrics in this report, and they are genuinely terrifying.
Yeah, the risk profile changes dramatically when you concentrate capital like that.
Dramatically is an understatement. The maximum drawdown for this top one momentum strategy doesn't improve at all. It actually plummets to negative 45.66%.
It's a huge drop.
We just established that a 27% drop would induce panic. This is losing nearly half of your money. You've basically traded our unbuckled roller coaster for a free fall drop tower.
It's definitely not for the faint of heart.
No sane investor can stomach that. You would panic and sell your entire portfolio at the absolute bottom.
And that highlights the inherent danger of a relative ranking system.
Yeah.
Yeah, if you put 100% of your capital into the single best performing asset, you are taking on catastrophic concentrated risk. You are completely exposed when that specific trend inevitably breaks.
Because even if an asset is the best out of our group of 10, that doesn't necessarily mean it's actually doing well, right?
Exactly.
It might just be the least terrible option in a crashing market.
Which is a crucial realization. It requires a fundamental pivot in the strategy. We need a mechanism that evaluates the actual health of the asset itself completely, regardless of what the other 9 commodities are doing.
Which introduces the next layer of the Quantpedia research, time series moving average management.
Yes.
And I actually like to visualize this one as the bouncer at an exclusive club.
That's a very fitting analogy.
Yeah.
The mechanics shift here from relative momentum to absolute trend following.
Right, so if the momentum ranking is just comparing the assets to see who is dressed the best, the bouncer evaluates them in total isolation. So how does the moving average actually filter them out?
Okay, so you take the price of the individual ETF, let's say wheat, for example, and you plot its current price against its own average price over the last 12 months.
Okay, simple enough.
And this creates a binary rule. If the current price is sitting above that 12-month average line, the trend is positive, and you keep wheat in your portfolio.
It's allowed past the velvet rope.
Yes. But the exact moment the current price drops below that moving average line, you exclude it entirely. You sell the position.
So the bouncer steps in, grabs the asset, and literally throws it out into the cold.
Exactly.
It doesn't matter if wheat is performing better than copper. If wheat's individual trend is broken, it gets kicked out to protect the capital inside the club.
And if we connect this to the bigger picture, the moving average essentially acts as a regime filter.
What do you mean by regime filter?
It mathematically identifies when a market has transitioned from a bull market, where prices are generally rising, into a bear market, where they are falling. By selling when the price drops below the line, you are essentially stepping aside during prolonged, brutal downturns.
Okay, so let's look at the bouncer's performance in the data. By applying this 12-month moving average filter, our return is a respectable 8.22%. And more importantly, the massive 45% drawdown shrinks to negative 31.55%.
It successfully cuts your exposure to those massive crashes.
But I'm still looking at a 31% loss here. I mean, it feels like we're just putting a bandage on a broken leg.
Still not ideal, no.
We managed to avoid losing half our money, sure, but we are still suffering worse drawdowns than our simple baseline portfolio. Throwing out the broken trends clearly isn't enough on its own.
Right.
Is there some underlying structural issue with combining these specific assets together?
That question points us directly to the fatal flaw in literally every model we have discussed so far.
Okay.
The missing link in this entire puzzle is a concept called uneven volatility.
Okay, let's slow down and really dig into this. Well, what does uneven volatility actually mean when they're building a portfolio?
Think about the physical realities of the 10 markets we are trading here. They do not behave with the same intensity. Energy markets, specifically crude oil, are notoriously chaotic. A single geopolitical headline out of the Middle East can cause oil prices to spike or crash violently in a matter of hours. Precious metals can behave very similarly during a market panic.
Right.
These are highly, highly volatile assets.
But agriculture is different. Like, a crop of corn grows at the exact same speed regardless of what the news cycle is doing today.
Exactly. Agricultural commodities tend to be much more stable. They move, certainly, but their daily price fluctuations are generally much tighter.
That makes sense.
Now, consider the baseline portfolio we started with. We gave an equal 10% allocation to oil and a 10% allocation to sugar.
Right, equal dollar amounts across the board.
In an equal weight scenario like that, the highly volatile assets will mathematically hijack your portfolio.
Oh, wow.
Even though oil represents only 10% of your total cash, its massive daily price swings will entirely dictate your overall performance. The slower, more stable agricultural assets essentially become invisible, just completely drowned out by the noise of the energy market.
Oh, I see exactly what's happening. Let me try a culinary analogy here.
Go for it.
It's like making a spicy stew, right? You decide to be perfectly fair with your recipe, so you put in equal physical weights of your ingredients. You drop in 1 pound of potatoes, which represents our stable agricultural commodities.
Right.
Then you add 1 pound of jalapenos, or let's say habanero peppers, representing our violently volatile oil and metals.
So you perfectly equalized the physical mass.
Exactly, but the stew is going to be completely inedible. All you are going to taste is searing heat.
Yeah.
The habaneros absolutely dominate the flavor profile of the dish, even though they only make up half the physical weight. If we want a balanced stew, we can't measure by weight. We have to measure by spiciness.
That perfectly illustrates the solution David Mezicek proposes in the paper. It's called cross-asset volatility targeting.
So how does a quant actually measure the spiciness of an EPF? Like, how do you physically implement volatility targeting in a real portfolio? Do we just buy fewer shares of the volatile stuff?
Mathematically, what you do is intervene before any ranking or buying takes place at all. You define a uniform volatility target for the entire portfolio. In this study, they used 10%.
Okay, 10% is the target.
Then you look at the recent historical price swings of each individual asset. If USO, the oil fund, has been thrashing around with 30% volatility, it is 3 times hotter than your target.
So you water it down.
You do. To bring oil's impact down to your 10% target, you only invest 1/3 of your standard allocation into the oil ETF.
Ah, okay.
And the remaining 2/3 of that specific allocation slot isn't put into other commodities. It's actually held in cash as a stabilizing buffer.
Oh, interesting. Okay, and what about the potatoes, the stable assets?
Well, if the sugar ETF has been very quiet, experiencing only 5% volatility, it is under your target. So to amplify its presence in the portfolio, you effectively double its allocation weight. By doing this across all 10 assets, you equalize their volatility contributions. You ensure that a 1% move in oil has the exact same impact on your total account balance as a 1% move in sugar.
That is brilliant. You give every single asset an equal mathematical chance to shine, based purely on its actual trend rather than just letting the wildest asset run the whole show.
Exactly.
This really feels like the missing piece of the puzzle. Let's look at the final optimized data when we put all of these mechanics together.
The results of combining these strategies are striking. We take the cross-asset volatility targeting to equalize the risk.
Yep.
Then we apply the 12-month look-back momentum strategy, but instead of just the top one, we select the top 2 performing assets to maintain some level of diversification. And the resulting equity curve is incredibly smooth.
And the max drawdown, that negative 45% nightmare we had earlier.
The max drawdown shrinks dramatically down to a highly controlled negative 11.85%.
Oh, wow. From a stomach-churning 45% drop down to under 12%.
It's a huge difference.
That is a masterclass in risk management. You can actually sleep at night with an 11% drawdown.
You really can. And furthermore, it achieves this safety while maintaining a strong 8.68% annualized return.
That's great.
Which gives the strategy a stellar 0.90 Sharpe ratio.
Wait, let me quickly translate that term for anyone who isn't staring at financial models all day.
Oh, sure.
A Sharpe ratio basically measures how much return you are getting for every single unit of stress or risk you endure. A low Sharpe ratio means you are taking on massive risk for tiny gains.
Which nobody wants.
Right. But a 0.90 in the commodity space is phenomenal. It means you are genuinely getting compensated for the bumps along the ride.
It represents the optimal balance. You capture the upside of the macroeconomic trends without leaving yourself exposed to catastrophic failure.
So, what does this all mean? If we step back and survey the landscape David Mesicek has mapped out for us today, we are living in a 2026 regime defined by Middle Eastern choke points and El Niño weather chaos.
Yes.
And passively throwing your money at a broad commodity index is just a trap. You will eventually get shaken out by a 27% crash. To actually survive and profit, you need a cold, emotionless system.
Absolutely.
Specifically, you need a 12-month look back to find the real trends, and you absolutely must use strict volatility targeting so that a single violent asset like oil doesn't secretly hijack your entire portfolio.
That is the definitive quantitative takeaway.
Yeah.
However, as robust as this math is, we were ultimately dealing with the real world.
Yeah.
And this raises an important question I want to leave you with.
I always appreciate a wrinkle. Let's hear it.
The entire Quantpedia framework is exceptionally designed, but it fundamentally relies on historical data. It uses the past 12 months of price action to smooth out your exposure for tomorrow.
Right.
But consider the actual nature of geopolitics. A military escalation in the Strait of Hormuz doesn't take 12 months to develop. It can happen overnight, without warning.
Literally a true zero-day shock.
Yes. If energy markets have been quiet for a year, the volatility targeting formula will read oil as a safe, stable asset and mathematically scale up your exposure.
Oh, no.
Right. So if a zero-day supply shock hits the very next morning, does historical volatility targeting actually protect your wealth? Or does looking backward temporarily blind you to an unprecedented instant crisis?
Wow, that fundamentally flips the script. I mean, it's the ultimate limitation of any algorithm history only predicts the future until the exact moment it doesn't.
Exactly.
That is a brilliant concept for you to critically think about. The next time you're standing at the gas pump feeling that pinch and a breaking news alert about global shipping lanes pops up on your phone, ask yourself if your portfolio is looking at yesterday's weather or tomorrow's storm. Until next time, keep diving deep.